So for today's tutorial, thought I'd talk about fixed income, about bonds. So the last few tutorials, I'd talked a bit about FX, so I thought I'd switch over to rates and bonds. Now, first of all, the one thing to sort of note with bonds are that you can go down a wormhole of a lot of complexity and maths. There's a lot of potential for that, but ultimately, there's certain very basic principles that you have to understand, and that will get you 90% of what you need to know about sort of bonds. Now, some things in terms of terminology, people say bonds, they say rates, they say fixed income, and they all kind of mean the same thing. You know, it's basically a bond of some kind. You know, some people say it's rates because you're talking about the rate on the bond. It's fixed income because the income on the bond is fixed. There's a coupon on it. So these are kind of interchangeable sort of terms. You can be a bit more precise and say fixed income includes some other things as well. But in general, when somebody say, I trade bonds, I trade rates, I trade fixed income, it's broadly the same thing. So that's the first thing. The second thing is that in the bond market, there's what you call sort of the benchmark, which is, it's called benchmark because that's a reference point for everything. And the benchmark in general is bonds issued by the government, because the government is viewed as a safest issuer of debt because they can raise taxes and pay for it, and they can also force the central bank to print money to buy it. So ultimately, the government in general should be the safest issuer of any debt. There are circumstances where that may not be the case. Often in poorer countries or emerging markets, you could have a situation where a company might be more creditworthy than the country. But even in that case, the benchmark is often then the US. So you end up finding a government that's the benchmark. And for the world, the benchmark is the US. So in general, the US is viewed as the top sort of benchmark. Then everything else is viewed as a spread or relative to the US in general. More specifically, when you go to regions, I would say that when you go to Europe, the German bond market, or what's called Bunds, or the German bond market is the reference point for Europe, for the Euro area. Japan obviously has its own one. And then outside of sort of developed countries, when you look at emerging markets, so Brazil or India or Turkey, the reference is the US sort of generally. Now, the first sort of basic question is, what is a bond? The way you can think about a bond is that, you know, in essence, it's kind of like a loan, a tradable loan in many ways. And there's three components to understanding how to understand the value of a bond. So if I share my screen, I'll just run through some of those just to make it a bit more sort of clearer for everybody. So the three kind of parts of a bond that you really need to know is what's called the face amount. Oops. The face amount, which is the amount the bond is borrowing. Sometimes it's called the principal amount, or sometimes it's called the par value. So let's say the US government is issuing a bond that has a face amount or par value or principal of, say, 100. So let's say that's $100, or we could say it's $100 million, or we could say it's $100 billion these days. So that's the first thing you need to know. Okay, how much is the value of kind of the loan that you care about? Now, the second thing is the coupon. So what's called the coupon rate. So coupon is just the way you can think about it is like a coupon you get at a shop. You know, it's basically something that will be paid to you regularly. So this is the interest rate, you could say. So, if we say the government will issue a bond on the 20th of January 2021, let's call that the issue date. Then we could say the coupon rate, let's say for this example, let's say it's 6%. Obviously, right now it's much, much lower, but just for this example, it'll make it easier for us to kind of work things out. So what this means is that every year, if you hold this bond, the buyer, so the issuer is the US government, and if you're a buyer or investor, you will kind of effectively lend, or you'll pay 100. So you lose 100, but every year you will receive 6%. So that means in year one, you will receive 6% of the principal. You'll receive $6 in that case. So what I can do is I can whoops. Let me just change this. So basically we're saying that there we go. So you receive $6 there. And then year two, you also receive $6. So, for the duration of the bond, or for the length of the bond, you receive $6 every year. That's a fixed amount, fixed income, it's a bond. And this is called a coupon. Yeah, so the coupon rate on this bond is 6%, which means that every year you get 6% of the face amount, or the par of the bond, and every year you get that amount. So that $6 fixed. So for this bond, every year you'll get $6. Now, the other important thing about a bond is the maturity date. How long is that loan for? So in this case, we'll say it's a 10-year bond. So that means it will mature in 2031. So that means it's a 10-year bond. So that means that in year 10, the principal will be paid back. So the government had borrowed this, it pays you back that principal, and it pays you interest on that last year as well. So every year you get 6, and then on the final year you get the 100 plus the $6 that repays the loan. So that's a basic structure of what we call a kind of a cash bond. So that's all fairly straightforward so far, I hope. There are some kind of nuances as well. You can, if you do trade cash bonds, it's also important to know how often the coupon is paid. Is it paid every 6 months? Is it paid annually? In the US bonds the coupon is paid semi-annually. So every 6 months you get your coupon. So you get paid 3% 6 months later, and then 3% the next 6 months. So in total, you have 6%. Some countries like, I think France and Germany, they pay annually. So every country has their own convention. In general, a lot of the major countries pay it semi-annually, but that's just as an aside. So that's the cash bond. Now the thing that often confuses people the most, especially new people to the market, is this whole idea of the relationship between prices and interest rates of a bond. So the idea here is that this is the issue price and issue coupon of the bond. Now the market rate is what the market determines the interest rate should be. So you issue the bond, on this day, but let's say, a month later or whenever, the market interest rates in the market, or the benchmark interest rate, for whatever reason, goes down to 3%. So the question then is, what would happen to the price of the bond? So the face value stays the same, but the price of the bond now, so it got issued at 100, but somebody who buys this now will have to pay a different price because interest rates have moved. So if the interest rate falls to, say, 3%, what happens to the price of the bond? So that's a question for everybody. So what do you think would happen to the price of the bond? So Vlad?
I'm assuming that the price should rise because there's an inverse relationship between price and yields.
Yeah, exactly. Yeah. So the way to think about it is that you get this $6 every year as a coupon. So in order for you to earn 3% a year, the bond price has to go up quite sharply. So if the bond price now goes to, goes up, then the coupon, which is 6, will imply a lower interest rate. So now if the bond price goes to 200, so if bond price goes to 200, and my coupon is 6, then the interest is 3%. Yeah. So this is the thing that really confuses a lot of people when they come into the market. This whole idea of bond prices going up and interest rates going down and all of these sorts of things. And the converse also is true. So if interest rates go up, then the bond price has to fall in order for you to generate that higher implied interest rate. And so when it comes to market terminology, this is important because when somebody says they're bullish on rates, or they're long rates, or they're long bonds, bullish bonds, all of these kind of mean the same things. Bullish or long means something's going to go up. And when people say that in markets, what they're talking about is the bond price. They're not talking about the interest rate. So if you say I'm long rates, I'm bullish rates, that generally means that you expect bond prices to go up, which means you expect interest rates to go down. So if you're long bonds, you are not saying I think interest rates are going to go up. You're not long the interest rate yield. So as a researcher, then you have to be very careful with language. So if you think interest rates are going to go up, you can say I'm bullish interest rates or I'm bullish yields. You can maybe say that, but generally, if you say bullish rates, bullish bonds, that means that you expect a rally in the market and the bond price to go up and the interest rate to go down. Equally, if you're bearish, so many people at the moment in the market are very bearish. Everyone thinks interest rates are going to go up. That means they're bearish bonds. They want to be short rates. So people have a short rates position, which means that they want to sell US bonds because they expect the price to go down. And if the price goes down, then the interest rate goes up. So is that clear? Okay, cool. Okay, so that pretty much gets you to like 50% of everything you need to know in markets, for rates markets. But this is important also because this idea that you trade the bond before its maturity. So most investors don't hold the bond to maturity. They're buying and selling the bond every 2-3 months. And so one of the confusions people have is, especially if you're a newcomer, is let's say German bonds trade at a 0.5% yield, 0.5% interest. That looks so low. So you think, who would want to buy that bond? Like who in their right mind would buy that bond? The person who would buy that bond is somebody who expects that interest rate to go down. So if I buy that German bond at 0.5% interest rate yield, if the German yields go down to say plus 0.2%, then I make a profit. Then I make a profit because the bond price has gone up. So this is one of the big things. You know, if you hold that to maturity, if I just held that German bond for the next 10 years, earning 0.5, my return's going to be terrible. You know, so what you can say that from a valuation perspective, the bond doesn't offer good value. But if I think in the next 6 months it's going to go down to plus 2.2, or it's going to go to minus 0.5%, I'll make money. You know, because I'm exposed to the change in the price of the bond. And that's why some people buy negative rate bonds as well. So if we take German bonds as the example, so this is the 10-year German bond yield. And if I, hang on, GDBR10, oops, sorry, GDBR10. Let me just wait for it to come up. So this is the German bond. So if I go back, say, to 2008, so if you look at German bond, they've just gone down in a straight line. So, you know, let me get rid of the moving averages. So, you know, back in early 2011, it was trading at 3.5%. People thought maybe, actually, let me go to max. Yeah, so this is you know, back in the mid 90s, it was 8%. It then fell to like 4% around 2008, and people thought, okay, 4% looks like it's good value because, you know, historically it's only been that high. So people thought, okay, let me start selling German bonds. Then we had the financial crisis, and it's been falling ever since. And then if you look at the more recent period, you know, we went negative in 2019. And so a lot of people said, oh, bonds are negative, so I'm no longer going to buy German bonds. If anything, I'm going to go short German bonds because I think the yields to go up. They would have lost a ton of money because bond yields went down, which means the bond price went up. So if you were shorting this bond, you would have lost a ton of money because it carried on going down. Now, recently, it's gone sideways. So if it goes sideways, then if you own the bond, you are just earning the interest. And in this case, the interest is negative, which means that if you hold the bond, you're actually paying to hold the bond. So you're losing money. But if bond yields were to fall, then suddenly you would start to earn money once again. So this is kind of the kind of core investment strategy. Now, there's a concept called duration in bond markets. So duration is effectively gives you a sense of the sense of the relationship between interest rate changes and changes in the price of the bond, or how sensitive is your position to changes in interest rates. And there's different versions of duration, but duration kind of gives you a sense of how your bond's price or value will change with interest rates. Now, one version of duration measures it in years. So if you have a 10-year bond, so e.g. for a 10-year bond, the duration, what's called the Macaulay duration, could be, say, 7 years. So there's a difference between the duration of a bond and maturity date. The duration in this calculation is based on kind of a weighted average of the present value of the coupons and the principal of the bond. So if you imagine, if you have every year you're getting paid the coupons of the bond, so 2 or 3 years into holding the bond, part of the value of the bond has already come to you because you've earned the coupons every single year. Sorry, go on.
Sorry, Bilal, we're losing your internet signal. You keep going in and out.
Sorry, let me change my connection. Okay.
It dipped out from the duration of 7.
Yeah. Okay, is that better now? Can you see me now?
Yeah,
Can you hear me
so.
now? Yeah, is that okay?
For me as well, yeah.
Yeah.
Okay, cool. Okay, so let me just kind of repeat that point there. So duration, there's different measures of duration, but in general, what the duration does is it gives you a sense of how the value of your bond will change if interest rates move. Now, one version of it measures it in years. So for example, a 10-year bond could have a duration of, say, 7 years. And the way duration is calculated is that you have your bond, which has coupons every year, as I had in this example up here. So you have your coupons year 1, 2, 3, and so on. You know, it was paying 6, 6, 6, 6, all the way to 10, which is 100 plus 6. And what this says is, because you're going to receive some of the coupons in the earlier years, if you present value all of these coupons and this payment, so present value means that you discount the coupons in later years by the interest rate. So present value is this idea that money today is worth more to you than the same money in 2 years' time. Because today, if you receive 100 today, you can earn interest on that. And in 2 years, you could earn 12. In this case, you'll earn 112. Whereas if you got paid 100 in 2 years, so that 100 in 2 years is worth less to you than 100 today. Because if you earn 100 today, you could put it in the bank, earn interest, and it's worth more. So duration essentially works out the present value of all of your payments that you receive to arrive at a number to say that it's, the balancing on the weight of your payments ends up being balancing around 7 years. So this, let's say the duration here, so the Macaulay duration, this is called Macaulay duration, is, e.g. in this case, is 7 years. There's a formula you can use to tell you that. Now let's pick another bond. What we can do is, there's another type of bond called a zero coupon bond, which means that the bond doesn't pay you any coupons. It's a zero coupon, so no interest. So what it does is it pays you the principal at the end, the face amount, and all the interest you would have earned gets paid into the principal at the end. So everything gets kind of, gets put up, into the end here. So that would be like 100 plus 6 times 10. So that's like a zero coupon bond. So the question here is, what would the duration be of this bond? Because the entire payment is in year 10. So what's the duration there? It would be 10 years. That means you're fully exposed to interest rates, i.e., because all of your payment is right at the end in 10 years. That means that you're very sensitive to interest rate changes, because that amount in 10 years' time, the present value of that will entirely depend on interest rates between now and the 10 years. Whereas, with this bond, after year 1, the interest rate doesn't matter because you've got some money in the bank already. Year 2, you got some money in the bank already. So 1 year's worth of interest rates you need to use to calculate the present value of that. So you're sensitive to that. Year 2 is sensitive to year 1 and year 2's interest rates. Year 3 is sensitive to year 1, year 2, year 3's interest rate. Whereas this one, you're sensitive to every single year's interest rate accumulated up to the end point. So the maximum duration of a bond is always, the maximum theoretical duration of a bond is always the maturity of the bond. So if a 10-year bond, the maximum duration possible could be 10 years, because that's when you get all your money back.
Is it clear? May I quickly give you my perspective?
Yeah, sure.
So guys, I mean, because if you're not dealt with, when I started working as well, I found this very complicated. Why this is important? In other words, what Bilal is trying to say, that 1% move in yield. So for example, 10-year yields, let's say they are around 1% right now, and a lot of people are forecasting it'll go to 150. So it's a 50 bip move. On top of your head, as a risk manager or as a portfolio manager, what that means is, so right now, this 7 years duration is trading at 9, actually. It's rough delta or sensitivity. In other words, if yield moves from 1 to 1.5, we will lose, because it's 50 bips, half of 9, which is we will lose 4.5% if you want to convert it into percent. So that's your profit and loss. That's how you think about it. That's why it's important. So if it's a zero coupon bond, if yield were, so if this is 10-year zero coupon bond, if yield moves 50 bips, it goes from 1 to 1.5. On zero coupon bond, we lose 5%. Yeah. So out of the two bonds, both are 10 years, but one is paying coupon. The bottom one is more risky in terms of its sensitivity to interest rates.
Yeah.
If the scenario was we all are expecting the rates to go down, it'd be the other way around, because there is something called convexity, but we will make more when interest rates go down. So that's why, and this 10-year, you just think of it as a percent.
Yeah. So yeah, just to clarify what Manan's saying there, the rule of thumb, although it's not perfect, but the rule of thumb is if you have a bond that has a duration of 7, that tells you that if there's a 1% change in interest rates, you will lose or make 7%. You know, the year is equal to a 1% change. So if interest rates go up by 1%, then your bond will fall by 7%, because because interest rates have gone up, your bond goes down, and vice versa. So that's kind of the general kind of rule of thumb. There is something, as Manan mentioned, called convexity, which is the idea that the duration is, it's like a curve on a chart, where the duration tells you the sensitivity of your bond to a change in interest rate right now. But if interest rates jump, the duration could change. The sensitivity changes as the interest rate changes. So the duration for a 0.5% change in interest rate could be 7, but then the duration, it could change if it jumps by 1%. It could change to 6, or it could change to 8 or something, depending on how the bond is structured. But we don't need to go into that so much. So duration is the first derivative, and convexity is the second derivative. And so for all these calculations, you need to know a bit of calculus in order to do the differentiation to work that out. But there's formulas, and Bloomberg and Reuters and all this, they do the calculations for you. And there's other ways of expressing this. You can express this in another form of duration, which is you could express it as what's called DV01, duration value, which is often how trading desks do it, which is to state how much money would you make if there was a 1 basis point change in interest rates. So if I'm long duration, I'm long the bond. If interest rates fall by 1 basis points, I could make $10,000. So my DV01 is 10,000. So then as a trader, then I know, okay, if rates fall by 5, then I can make 50,000. So that's my P&L for the day. So traders often talk about DV01, which is duration expressed as a nominal amount on their kind of risk. But the general idea of duration is it gives you a sense of the sensitivity of interest rates to the value of your bond. So obviously by this, it tells you that very short dated bonds, so if you had a 1-year bond, the duration is very low. It doesn't, if interest rates move around a lot, it won't really change, the value of that 1-year bond. The 1-year bond will be what it is. But obviously a 30-year bond will have a very high duration. And a 50-year or 100-year will have a very, very, high or long duration. So what we've talked about is the inverse relationship between bond prices and interest rates. We've talked about the fundamentals of cash bonds, coupon rate, par value. We've talked about duration, which relates prices to yield. The two or three other things I wanted to mention was the yield curve. So we have, let me pull up Bloomberg here. So this is let me just pull this up. So this is the US yield curve. So yield curve essentially tells you is all about the if you drew a chart of all the interest rate points for US bonds. So the 2-year interest rate bond, the 2-year bond in the US has an interest rate of about 0.11 or point. Let me return the chart here. So the 2-year bond has an interest rate of 0.12. The 10-year has 1.04. The 30-year has 1.8. And so if you plotted that as a chart, this is how the US curve looks. So when people talk about the curve, they're basically talking about a current snapshot of the maturity of a bond, or the tenor and the maturity is the same thing, and the interest rate on the y-axis. And the yield curve, then it can be defined in different ways, but yield curve is usually the difference between 2 points on this curve. And it's usually, and the yield curve is expressed by the longer date minus the shorter date. So you could look at the yield curve, you could say 2s, 10s yield curve is 10-year minus 2 years. So what you can say is 2s, 10s, the yield curve is positive, it's upward sloping. So that means the curve is steep. And one way of expressing that is say, I'm going to look at 2s, 10s, and 2s, 10s right now are 1.06 minus 0.13. So it's roughly, 190, 1.9% roughly. So that's one measure of the yield curve. Some people say, okay, I'm looking at 5s, 30s. So that's 30-year minus the 5-year. So if I go back to the spreadsheet here, so the yield curve is what I just showed you. It's the current snapshot of interest rates at different tenors, maturities, and investors' maturities, and common curves include 2s, 10s, which is equal to the 10-year yield minus the 2-year yield. And another one could be, say, 5s, 30s, which is the 30-year yield minus the 5-year yield. And when people express these, you can express it as, say, 2%, say, if that was the spread, or you can say 200 basis points. So from a terminology perspective, 1% is equal to 100 basis points. So often people express things in terms of basis points rather than percentages. So is that clear?
Bilal, sorry.
Sorry, say that again. Sorry, say that again.
I was wondering whether basis points are the same thing as bips.
Yes, it's the same thing. Yeah. Basis points, bips, they're the same thing. Yeah.
Points are bips or not?
Vlad, you're breaking up a bit. Yeah. So bips hips. They're kind of the same thing. So they're kind of the same thing. So this is kind of the yield curve. These are two common expressions of the yield curve. You can look at any point. You can look at 3-year, 3s, 5s, 3s, 7s, and all these sorts of things as well. But these are some of the benchmark ones that people tend to look at. Now, the final thing I wanted to mention was terminology around flattening and steepening. So you have something called bear steepening. And you have something called bull steepening. And there's a few more which I'll mention. So bear steepening, as you can guess, means that the curve is going to steepen. So steepening means that if we look at, say, 2s, 10s, if the curve steepens, that means that the 10-year will go up more than the 2-year. So then you end up with a steeper curve. Now, there's two ways the curve can steepen. One could be that the 10-year moves up more than the 2-year, or the other could be that the 10-year falls, but the 2-year falls by more. And that's called a bull steepening. So they're both steepening, but in one scenario, the 10-year interest rates are going up, and that's called a bear steepening. Bear because you're bearish prices. So 10-year bond yields are 10-year bonds are selling off. So the price is going down. 10-year interest rates are going up. So the reason it's steepening is that the 10-year interest rates are going up faster than the 2-year interest rate. That's a bear steepening. Bull steepening is actually 10-year interest rates are falling. That means bonds are rallying, but the 2-year is falling by even more. So you end up in what's called a bull steepening. So is that clear?
A quick question on that. But so for the bull steepener or the steepening, but isn't it a good thing sometimes if the long end of the yield curve goes up, because that means that there's more inflation, which should be an indicator of growth?
Yeah. I mean, so what we're doing here is these terms are just explaining, is just market jargon to explain the specific way the curve is moving. It's not saying if it's good or bad. So the term bear or bull is bear is just referring to the fact that bond prices are going down. There's no value judgment attached to that. It's not saying it's good or bad. So if I said the curve steepening, that's information that's useful to you. But if I then say it's bull steepening, you've now got an extra information point there, which is that the reason it's steepening is that actually 10-year yields are falling, but 2-year yields are falling by even more.
Gotcha.
Yeah. The scenario that could happen is if the Fed was to cut rates aggressively. Let's say the market's expecting a recession, 10-year interest rates start to fall, but then the Fed comes and cuts rates aggressively, the 2-year point will fall probably by more than the 10-year. So you end up with a bull steepening. At the moment, the market, most people are positioned for a bear steepening, i.e. they don't really think 2 years, the front end, what's called the front end, will do very much. Everyone's expecting the long dated part of the curve, the 10-year, to sell off. So a bear steepening, which is kind of a classic kind of inflation, fiscal problems, growth kind of backdrop.
Thank you.
Now you can have the same things on the other side as well. You can have so bear steepening means 10-year yields have gone up more than 2-year, and then bull steepening means have gone down by less than 2-year. And then you can have the opposite as well. You can have a bear flattening and a bull flattening. So if you go back to this chart here, a flattening would be if the 10-year was to start falling versus the 2-year, the curve will start to flatten. It goes flat. So if this was to fall here, say, then suddenly the curve has gone flatter. And again, just like the steepening, there's two ways that can happen. A bear flattening means that the 10-year yields have actually gone up. So the only way that could lead to a flattening is if the 2-year went up by even more. Then you end up with a flatter curve. And bull flattening, which is a more classic way of flattening, is 10-year interest rates are falling. So the bond prices are going up. They're falling by more than 2-year is moving. So then you have a bull flattening. Is that clear? Yeah, have gone up by less than 2 years, have gone down by more than 2-year. Now, the other thing I just realized when I was speaking is that you kind of have kind of short-term or short-dated bonds, and you have intermediate bonds, and then you have long-dated. And usually there's a bit of difference in the market how people talk about this, but generally short-dated means 5 years or less in terms of maturity of the bond. Intermediate, or sometimes people call it the belly of the curve, because it's like at the middle of the curve, is 5-year to 10-year. And the long dates are normally 10 years plus. So, you know, if you're exposed to long dated bonds, it usually means you're exposed to like the 10-year, the 20-year, the 30-year. The belly is usually the 5 to 10-year part of the curve. And then the short dates are 5 years or less. And that's generally kind of the terminology there. So I think I'll stop there and take any questions. So the purpose of this was to kind of introduce you to the basic mechanics of bonds, and importantly, the terminology that people use, and some of the key benchmarks that people refer to. So any questions from anyone?
Sure. I've got 2 questions, if that's okay. So the first question is, so in terms of the participants in the bond market, so this is going back to where you had mentioned that, like if you wanted to buy negative, so for example, buying negative rate bonds in the expectation that the interest rates will continue to fall. So in terms of market participants, is it that are most buyers buy and hold investors, and then it's kind of the speculative traders that trade on the edges, or actually the bond market is driven by the speculative flows?
Yeah. No, that's a very good question. I would say in general, you know, the big holders of bonds in say the Eurozone or the UK or the US, you tend to find, well, these days, central banks are one of the biggest holders of bonds. Then the other big holders of bonds are what you call kind of like real money, like pension funds, insurance companies, and they tend to be buy and hold. Then you have kind of asset managers who are kind of related to pensions and insurance, but they're kind of another part of the industry. And what they are is they tend to be benchmarked. So there's like a global index of bonds, and they're benchmarked to that bond, that index. So they kind of have a core kind of hold exposure to those, but then they overweight, underweight certain bonds all the time. So they're kind of trading around, you know, so they're long, you know, 100 units of German bonds. Then they might reduce it to 99, or they might increase it to 101. So they're trading around that. Then the other big holders of bonds are banks. So banks hold lots of bonds as well. And that can be both buy and hold, and also for liquidity purposes. And then you have the speculators who kind of buy and sell. But what all of these people do is, even though they may hold the bonds until maturity, they're trading around the bonds a lot as well. So they hold the bond, and they overweight it, they overlay it with what's called swaps, interest rate swaps often.
I see, yeah.
Or hedge funds might use futures, you know, to kind of underweight their exposure. You know, so for example, a pension fund often will have certain rules about having to match the assets and the liabilities, because pensions, they have to pay out to people above the age of 65, so they kind of have a sense for their payouts. So they need some kind of regular way of paying those people. So they want to hold bonds because they pay coupons, And so if they hold a 20-year bond, if that becomes a 2-year bond, they might just sell that, because they want to maintain a certain duration or maturity to match their liabilities. So they'll kind of start to sell those bonds, the shorter date bonds, and buy the longer dated bonds to make sure that they always have some visibility on their payments.
Gotcha.
Going forward.
And then my second question was just a technical question in terms of the TB01 and the duration. So are you referring, so for example, if you have a 10,000 TB01, does that refer to the change in of 1% in interest rates in the short term, or whatever the duration of the bond is?
It refers to the way you could think about that is, if a trading desk or hedge fund has, has like 20 bonds it's holding, 20 US bonds it's holding, the DV01 will tell you the short-term change in the value of that portfolio if there's a change in interest rates.
Right.
So it's kind of like a short daily measure. So let's say I'm holding 10 US bonds right now, 5-year bonds, 10-year bonds, 30-year bonds. I'll work out the DV01 off my portfolio, and it may come to $10,000. Then I know today, if interest rate fell, then that's my exposure for today. Okay.
But the interest rate that falls, is that the short-term interest rate, or that's referring to the short-dated interest rate?
Oh, sure. So in general, it refers to the 10-year.
Okay, gotcha.
Yeah.
But typically in a bank, is represented across the curve. So it will show you 3-year as this much DV01 and 5-year as this much DV01, and then the move across the yield curve. If you average it, like parallel move, because yield curve generally moves in parallel. But like at a certain point, barely a 5-year has moved a lot, you can certainly know that my 5-year duration is this. This is how much I lose if my 5-year moves the most, because that's where I'm most sensitive.
Okay, gotcha. Thank you.
Any more questions?
Yeah, just in terms of the practicality, when people trade bonds, do they generally trade second-hand bonds, or how frequently does the Treasury or does the government reissue new bonds? Is it are they two separate markets, or?
Yeah, no, that's a good question. So there's called like the primary issuance. Primary is when an entity issues a bond, that's a primary market. So the government has like the Treasury function has an auction, every week, every month for different tenor of bond. They have an auction, and people come into the auction and they buy it from the Treasury. That's the primary market. Then you have a secondary market where people then, the bond's already issued, then somebody comes in to, want to buy the bond in the secondary market. So typically in the primary market, you tend to find some of the longer term players are very active in the primary market. So reserve managers, for example, like the Chinese or something, would sort of buy up a significant amount of bonds in the auction. And otherwise, you then enter the secondary market as an investor to buy the bonds in the secondary market. The other ways you can get exposure to bonds, you don't have to buy the cash bonds. You can also use futures. So futures are contracts traded on the exchanges, so the CME in the case of the US, which links its value to the value of, roughly speaking, the cash bond, and it kind of accrues the interest and it works out. So the 10-year bond in the US is the TY contract, and you buy, the 3-month TY contract, which gives you the price, the expected price of the cash bond in 3 months' time, and you buy and sell that futures contract. Or you can use swaps, which is the much bigger market, which is a swap. In essence, is a transaction where one person wants to lock in rates, say for 10 years, like a 10-year swap, and the other side of the transaction, somebody wants to go floating. They want to pay the floating interest rate for the next 10 years, and there's a transaction between the two. But that contract, generally speaking, follows a cash bond market. So a lot of people could trade swaps, because it's much more liquid. So people will buy or sell swaps to get exposure to interest rates, depending if they have the systems to do that. There is a spread between swaps and cash, and that spread reflects the credit of the bank, because a bank is the one that is creating that swap. So you face the bank, and so if the bank blows up, then suddenly you lose that contract. And so in theory, the spread between swaps and cash bonds should reflect bank credit. It also reflects liquidity. So sometimes the swap yields go below cash, because of certain supply demand dynamics in markets. But when you want to be very precise and you want like 1 year, 2 year, 3 year, 4 year, 5 year, interest rate swaps is what you tend to use. It's a cleaner, it's more liquid part of the market. But it's anchored to the cash bond sort of market. The other thing I should mention about cash, now that you mentioned auctions, is that if you have a 10-year bond, let's say it's issued today in January, and then in 3 months or 6 months, another 10-year bond gets issued. You now have two 10-year bonds, which are roughly 10 years. They're 6 months off from each other, but they're two 10-year bonds. The next 10-year bond, the most recently issued 10-year bond is called the on-the-run bond. And the 10-year bond that was issued, just before is called the off-the-run bond. And so there's a lot more demand for the most freshly issued bond for lots of different reasons, because people enter the primary market and so on. And so there's often a spread between the off-the-run bond market and the on-the-run bond. Back in the day, in the 90s and 2000s, I used to look at the spread between the two to get a sense of the liquidity premium in the market. Because if there's a spread between the two, the spread can't be due to a difference in credit, because the government's issuing the bond, so it's the same entity, so they're equally likely to default. So why is there a difference between the two? It's to do with liquidity. That means one is traded more actively, so the other one has a high interest rate to compensate for the fact that it's less liquid. So it's harder to get a price, so it has to offer a higher interest rate. But in recent years, because of so much central bank intervention and QE, the spread between the two has got so small now, it doesn't really mean much.